So I'm delighted to kick off the second day of, as usual, another outstanding conference organized by Susan. I've had the privilege of being at least 4 or 5 of these before. I think I missed one. This paper is joint with Alexander Kemp from Cologne, Daniel Mayston from BlackRock in London, and Monica Trapp from she's at Cologne, you can say, and of course I'm working on it. So this paper is about resiliency, and of course in the business world, resiliency is clearly important. And what we are going to talk about is resiliency in the context of liquidity. So when we think of liquidity, what is liquidity? Liquidity means different things to different people. So somebody who's in macro will think of liquidity as money. Somebody who is looking at the firm level might think of liquidity as solvency. When we are talking about liquidity, we are thinking of it from a market's perspective. And so we're thinking about liquidity as the ease of trading securities. And therefore, the first thing which arises is, how do we measure liquidity? Can't resist quoting Maureen O'Hara here. Liquidity, like pornography, is easily recognized, but not so easily defined. So we have the challenge of defining liquidity. And the seminal literature in market microstructure thinks in terms of liquidity having at least 3 main dimensions. The first dimension is the cost dimension. So how much does it cost to trade? And this area has been extensively researched. Trading costs have been the subject of innumerable papers. The next is the quantity dimension, depth. How much can be traded at the current price? And we have, once again, a reasonable amount of research on depth. There are different ways in which you can think about defining depth, but nevertheless, it's reasonably well researched. And the third dimension is the time dimension, which characterizes the recovery of a market after liquidity shock. And here, it has, I have to say, it's been researched to a very limited extent, even though resiliency as an important dimension of liquidity has been cited way back in 82, 85 in some seminal work. So this paper is about investigating resiliency in liquidity. Now, when you think of when you think of a recovery of a market after a liquidity shock, you can think in terms of several attributes. You can think in terms of recovery of prices, and some of the work of some of the focus in Kyle and Harris is on recovery of prices. So we are not going to talk about liquidity, resiliency in prices. That's subject to another paper. We are going to talk about resiliency in liquidity. So what do we mean by that? So if we look at a limit order book, we have the buy side, we have the sell side. And suppose this is what the book looks like. The best ask is 80.5, and the best bid is 79.5. And in comes a trade at 79.5, and the book changes. So it removes the best on the bid side, and therefore now the spread has increased from 1 to 1.5. And when you think in terms of resiliency, we think in terms of what's going to happen next. Is the spread going to come back? Is the depth going to come back? And yes, of course, there is a new buy offer, and the depth comes back. So that is what we mean by resiliency. We can think in terms of resiliency in the depth. We can think in terms of resiliency in the spread. And that is what resiliency in liquidity means. So we define and empirically investigate measures of resiliency that represent essentially the extent to which scarce liquidity gets replenished when it is removed as a result of an order, or excess liquidity gets consumed, and we think of the amount of excess liquidity consumed or scarce liquidity replenished within a pre-specified time interval. And of course, that replenishment and consumption comes about as a result of the competitive actions in the market of value traders, dealers, and other market participants. So how does that make the market more resilient? Now, why is resiliency important? Markets around the world are now increasingly organized as electronic limit order book markets. So gone are the days of the specialist in the New York Stock Exchange or the market maker on the London Stock Exchange. All across the world, we have electronic order-driven markets. And in these markets, these are liquidity supplied entirely through, voluntarily through limit orders, which are posted by market participants. And therefore, these markets are very crucially dependent on the existence of adequate resiliency. In dealer markets, market makers are contractually obliged to stand ready to buy and sell. But here, it is an empirical issue as to whether enough liquidity is submitted to the book as liquidity gets consumed. And it therefore affects, if you like, the stability or the fragility associated with the requests to trade of liquidity demanders being always available to get fulfilled. And particularly in the algorithmic trading world, this has become even more important because of the perception, at least among regulators and others, that algo traders withdraw very easily when the going gets tough. So that's an important aspect of resiliency. Another aspect is that arbitrageurs, for example, need resiliency for fair pricing and market integrity because what resiliency does is determines the volatility of trading costs and tradable quantities. And high resiliency decreases these risks and, of course, decrease the margins at which arbitrageurs are able to trade. Institutional traders also break up their trades into smaller blocks, and therefore, once again, high resiliency speeds up the execution of successive blocks. Now, in terms of theoretical models, there's pretty much one theoretical model in the literature which was published in RFS in 2005. It's a model of a limit order book market with traders of different degrees of impatience. And when you think of impatience, we're talking about whether you would post a limit order and therefore be patient for it to trade, or whether you would demand liquidity immediately and be impatient. And the model concludes, is pretty much the first and only one to look at resiliency. It looks at spread resiliency, so liquidity for resiliency in spreads. And it concludes that spread resiliency increases as a proportion of patient traders increases, order arrival rate decreases, tick size increases, and at the end of the trading day. It does not model depth resiliency, but a lot of the considerations in the model apply to depth resiliency as well. And since I do not want our esteemed chairman to be standing next to me at some stage, with all due respect, therefore I will not go into more detail on that. Suffice it to say that the implication of depth resiliency can be argued to be very similar. The model does not include any information-related considerations at all, so that's a basic limitation of the model. The empirical work in this area is virtually non-existent, and whatever is, it's focused on extreme events. There's a paper by Bhattacharya and others, how large can stocks get before exchanges close down. Another paper by De Gries and others, and one or two others, which relates to how does liquidity react to very large trades. But there's no general analysis of resiliency after the recovery after a liquidity shock, and that's what we seek to provide in this paper. We provide a framework for measuring resiliency. We provide descriptive analysis of resiliency, how resilient are electronic limit order book markets. Is resiliency a priced risk factor, which is clearly important in the context of the pricing of other dimensions of liquidity. And what are the determinants of liquidity? We test the Foucault et al. Hypothesis, and we test for the causal relevance of considerations we argue to be important. For example, competition across different trading venues, information-related risks, and algorithmic trading. And we use the FTSE 100 stocks. It's a good quality data set of high-frequency order book snapshots of the FTSE 100 stocks. We choose the FTSE 100 primarily because data is available, and I have lived in Britain 15 plus years. But also because of the fact that It's an electronic limit order book, has 99% of all orders which are traded in the market. So it's all focused liquidity into one exchange. There's a very large cross-section of stocks, of 120 stocks. There's a very large variation across these stocks. The average trading volume varies from under 1 million to 153 million a day. So that's the sort of logic of using the FTSE 100. Our observation interval spans 2007, 2009. It's a long time series, relatively speaking, in microstructure terms. And it spans both calm and highly volatile market phases. How do we measure resiliency? I'm afraid this has not come through in the PDF. We can't use the PPT file? Sorry. My fault, I should have sent a PPT file. I sent a PowerPoint. I should have sent a PDF file. I sent a PowerPoint. We think of, the equation at the bottom is pretty good. I don't know why it has come through. Essentially, we look at the change in liquidity from today till tomorrow, say, but we're looking at 1-minute intervals, from this period to the next, and model it in terms of the level of liquidity in the previous period. So we are thinking about it as liquidity mean reverting to around an average liquidity level. So the kappa here captures the mean reversion of liquidity around a target liquidity level, and that is resiliency, because that represents how the liquidity bounces back once it is taken away from an average level. I have lost all figures here. This is not going to work. So anyway, resiliency is about 0.65%, about 0.65, which means about 65% of the deviation from the average level liquidity is reversed back. So imagine there is a graph here, and that graph shows it roughly to be fairly stable. If you look at now this thing at the top of it was sent by my co-author. It's not meant to be in German, but I think somehow the computer has found it in German. So ignore that. The average half-life of liquidity deviations is about 6 minutes. The average is about 0.6 or 60% of the liquidity deviations are reversed on average. The minimum is about 0.4, maximum about 0.8. So it is very, very resilient. There is very little difference between small stocks and large stocks. Small stocks are a little bit less resilient than large stocks. And once again, imagine that this is very stable. The market resiliency is fairly stable over time. And on the other hand, imagine that the market spread is not at all stable and varies a lot. So resiliency is very stable, and spread varies a lot with time. And that and spread is, of course, the cost dimension of liquidity, and resiliency is the time dimension of liquidity. Now, the first thing we examine, for example, is resiliency a price risk factor? And the formatting has all gone wonky here, so I will just talk it through. So we use the time. We use whether resiliency is a price risk factor or not. We use two approaches. One is a time series approach in the spirit of Brennan and Surman in 1996. Another is a cross-sectional approach, which is the traditional asset pricing approach. We sort stocks into 6 portfolios based into 3 resiliency classifications and 2 size classifications, and compute equally weighted monthly excess return. And then we regress these portfolio return on portfolio resiliency and control variables. So the first thing is that we compute the excess returns, and then we regress them on the portfolio return and portfolio resiliency to see whether resiliency has an explanatory power in relation to the return which investors demand from the market. Fortunately, this has come through. So if you look at the time series and you look at the column corresponding to daily return and monthly return, so you will see that small resiliency, if you compare small resiliency, medium resiliency, and large resiliency, you would find that returns are lowest for the last large resiliency category across the board, which means that investors demand a lower required return for more resilient stocks, which is what you would expect given that liquidity is something which illiquidity is what you need a premium for. So, and you find that for both daily return and monthly return, you find that for both spread resiliency and depth resiliency, both across the board. And when we look at when we do the actual regression, we again find that both for depth resiliency and spread resiliency, the coefficients are extremely significant, where you, for both daily returns and monthly returns, there is a strong evidence about resiliency being priced by the market as being important from a pricing perspective. And all the others, spread and depth and others, are much less significant. It's the most significant out of all the variables. And that result is completely consistent with another paper I have on bond markets, which again shows that resiliency is much more priced than the spread and the depth. Then we also look at commonality, how resiliency varies across stocks. And we find that there is a very strong degree of commonality across different stocks. So if you take spread resiliency or depth resiliency, both about 80% of the variation in those variables is determined by an overall market resiliency. So it is like the market model or the capital asset pricing model, where you find that indeed the security returns are dependent on market returns. And when we do the traditional approach of looking at whether resiliency is a price risk factor across the portfolios, we once again find very strong evidence about the coefficients being significant and not significant for the spread and the depth. And in fact, these are quite consistent with what exists in the literature for those variables. So once again, resiliency appears to be a strongly priced factor, even in a small data set of about 2 years, which from an asset pricing perspective is quite remarkable. We then go on to look at what are the determinants of resiliency. And the first thing we do is to test the Foucault et al. Hypothesis, which relate to 3 variables. One is the proportion of patient traders, the order arrival rate, and the tick size. And we ask the question, is the resiliency a function of these 3 variables? And are they associated? Do these 3 variables cause resiliency to be different? And the first test we do in that regard is an association test. We just run a regression. And when we do that, once again, we find that we find very strong support for each of the Foucault et al. Variables. We find that the proportion of patient traders, the order arrival rate, and the tick size, all of them significantly change both spread resiliency and depth resiliency in the right direction, in the direction predicted by the model, and the adjusted R-squares are pretty high. So therefore, there is good support for the Foucault et al. Model. Then we then look at information risk. So we would expect clearly that if there is a large amount of information risks, it will make it more risky to supply liquidity, and therefore it should lead to arguably lower resiliency. And therefore we have the same model as before. We have the same variables that we have, but then we add on an information risk variable to the mix. And what do we find? When we add on information risk variable to the mix, we need to proxy information risk, and we proxy it in 2 ways. One is by the volatility, and the other is by the imbalance in the proportion of executed orders, both of which are very extensively used in our field to proxy for information, in order imbalance to proxy for information asymmetry, while volatility to proxy for the news flow, and therefore information. I'll try and quickly. So we once again find that it is strongly predictive. Then we say, okay, algorithmic traders act as liquidity suppliers and should therefore lead to higher resiliency. What do we find? We add in algorithmic trading to the mix. And once again, we find that algorithmic trading increases resiliency. However, we also find it does not do so in volatile periods, and particularly for large stocks. And it does so particularly for large stocks. So we do that by interacting it with other variables here. These variables, this is significant, and these variables. And I'll come to the next stage, which is establishing causality. So what we've established is an association. Can we say that these variables actually cause resiliency? And therefore, we look at traditional tests for causality, and in three different dimensions: competition, fraud, execution, information, risk, and algo trading. Three things. And we first do simple Granger causality tests. And we do simple Granger causality test. We find that the proportion of patient traders, order arrival rate, volatility, and order imbalance, they predict resiliency, but not the other way around. The other way around evidence is much lower. So a simple Granger causality test suggests that that the causal direction is from those variables to resiliency. Then we go about doing a traditional instrumental variables approach, and for that we need exogenous events. And we choose 3 exogenous events for 3 different categories of variables. So first of all, is competition order flow. We use the proportion of patient traders and order arrival rate. And for them, we note the fact that Chi-X was an exchange which started coverage of FTSE stocks in our sample period, then Turquoise, and then BATS. So we have 3 different exchanges starting to trade the stock, each of which will arguably impact the competition for order execution, and therefore it counts as an excellent exogenous event. And for volatility and order imbalances, our event is not that good, but still reasonable, which we use the search intensity in Google as an index for investor demand for information. And we use them for both volatility and order imbalance. And for algo trading, we found that there are 4 decreases in latency in our sample period, and we use each of these as events for looking at exogenous events for using of instrumental variables. And we find, once again, very strong results. Where we can show that after having controlled for these exogenous events, taking the estimated variables, our results hold even more strongly than before in terms of the relationship with PPT, OAR, and all these variables. So we can therefore conclude that our results are not due to endogeneity or an omitted variables issue. We also do a few other robustness tests, which I'll skip a little bit more in the interest of time. We have time with the day dummies. We have an asymmetric model, which is all wonked here in terms of the figures. So please ignore the figures. The figures have not come out formatted. But we look at consumption resiliency and replenishment resiliency. So if there is excess liquidity, how quickly does it get away? If it's short of liquidity, how quickly does it get replenished? We find no differences. Consumption resiliency is slightly larger, but differences are not significant, and determinants all remain unaffected. Then we look at the financial crisis, and I am slightly afraid of my chairman, so I think I will skip this. We argue that the financial crisis, replenishment resiliency, and consumption resiliency will be different during the financial crisis and outside the financial crisis, and we find results which are consistent with that. So I'm going to omit that. And then we also look at resiliency at quotes, which are not just the best quotes, but really at higher levels, and we find that our results remain pretty much unaffected. So the summary and conclusions really are that when we look at resiliency in a general framework, we find that linked order books offer high and stable resiliency. More importantly, we find lack of resiliency is a priced risk factor and fairly strong evidence for that. We also find strong support for the fact that resiliency is high when competition for execution is high, where information risks are small, where algorithmic trading is high, but not when volatility is high. So when in extreme periods, things are different. And our results are robust for both consumption and replenishment resiliency across different time periods and when measured at different ticks. And since this is the first study on resiliency in electronic limit order book markets, and in addition to the economic factors, we hope that will be quite valuable. Thank you.
So what I'm going to do is focus on this concept of resiliency from, I'm going to put on my practitioner hat and less of an academic hat, and also sort of lead you into what is the important thing about resiliency. And I think I totally agree with the authors that resiliency is a concept that has not been studied too well. And I think it is getting very important now. And I think it's important that we get to understand what needs to be studied. So I'm going to give you some thoughts. And again, these are all some comments, suggestions that Pradeep and his co-authors can take away. And then the second part of it, I'm going to focus on the market structure as I see it in the London Stock Exchange during this time, because we used to trade in them. And it's very important to understand how that market structure allows you to do this testing, because I think that's important, because the underlying market structure could actually make the study easy or difficult. And then the third part of it is keeping the objectives of the authors in mind, which is studying the spread resiliency. I want to actually go and see whether the data that they're actually using is conducive to do this test. So again, all of these are going to be some suggestions, and I hope it will be useful to you. Okay, so resiliency is very important, especially in this algo world, right? And why is it important? Because as you know, there's a whole lot of, I think yesterday Yesha was saying there are about 10 flash crashes a day or something like that, where there are a lot of these very periodic, mini episodic crises, which allow markets to suddenly become illiquid for a short span of time. And then it depends a whole lot on people, new people coming in, or people understanding that this is just a temporary liquidity shock, and then the market comes back. And I think that structure is even more important when you have a liquidity provision that is entirely voluntary, right? So where you don't have affirmative obligations of market makers who need to be there to protect that the spread doesn't get too far from its equilibrium levels. So I think that is a very important part, which I think a good study of resiliency will feed into regulators, and the regulators will be able to understand, whether HFT is good or not. We all know, I think there must be a zillion papers out there which generally say HFTs are good in most of the times, right? So it's only during the crisis or during these crash periods do they exacerbate these shocks and they stop providing liquidity. We have some anecdotal, some evidence out there as well, but the resiliency measure will actually capture the ability of the markets to bounce back. And I think that's very important for that. And I want to actually address a practitioner's understanding of resiliency, which is also very important, and it actually is an endogenous thing, right? Because what we do gets into your data. And I think the way typically if you think about broadly two sets of traders out there, right? There are traders who are direction traders. So we're taking positions, we're buying now, hoping that the prices will go up, and then they sell later. So these people have the ability to come in at whatever period that they think is useful to them, but whenever the values are low. On the other hand, you have these, let's say a large mutual fund which has already made a decision to buy or sell, and they need to execute the order over a period of time. For them, resiliency directly feeds into how they schedule the order. So for example, a typical large institution, a buy-side institution, would start saying that I want to buy 100,000 shares of Microsoft. I need to piece it over a period of day. And typically, as Pradeep mentioned, they break the orders into small lots. They keep trading. And one of the inputs into that scheduling algorithm is how quickly markets bounce back. The moment I put in my trade, the spreads widen, then what do I do? How long do I wait? If the markets are not resilient, then obviously you cannot complete the order by waiting. You got to speed up. And by speeding up, you're going to make the markets even more wacky or go out of line. So in other words, what I'm saying is the resiliency is sort of an input into the algorithms that most people use. And in fact, they assume, this is how the markets will bounce back. And typically, for example, we have a small time window by which we would expect the prices to bounce back. And therefore, our next order will be shot back into the market. So the reason why this is important is in that scenario, typically people don't assume information. So the assumption is purely liquidity. So somebody goes in, the order widens because of liquidity shock, and market assumes that it is an uninformed trade and it will bounce back. So when you suddenly throw in information, like say a large firm like Goldman starts trading and people assume it's Goldman trading, then the prices will not come back. Sometimes the spreads would widen and they'll stay widened because people are not sure who's on the other side. So I think the broader point is resiliency is very important for practitioners as well. And a lot of them make assumptions in a very trivial way when they put it into the algorithm. But it's a hugely endogenous issue because we assume how other people are going to react and they assume how we will react. And together we do something in the marketplace and which you assume as the way the markets work. So I think there is a thing that needs to be fleshed out a little bit more. I think the authors do a very good job of highlighting this role of resiliency, and I think they have also tried a good job of capturing it. The version of the paper that I saw did not have this asset pricing thing, which is one of my comments of taking it to the asset pricing level, but that's something that they have already taken care of. So now I'm going to spend a little bit time on what I think is important here. So I may be completely wrong, but this is my understanding of resiliency. See, the typical construct is that, I guess mine is also screwed up. So traders can be informed or uninformed, and prices move after a trade. And usually the resiliency as described in Kyle and Harris and all those guys is about how prices bounce back after an uninformed liquidity shock. And the focus is on prices. Okay? So you have a bunch of people I have mentioned again. Harris, my advisor, got cut out from here. But the focus is all on the prices. Okay. So the focus in this paper is on the spread resiliency. So in other words, the prices level might change, but if the spreads remain as before, in a relative sense it will affect because the prices are going to be included in the calculation of the relative spread. But by and large, for example, I'm going to give you a simple example. This is the offer and this is the bid. So this is how the spreads are and this is the mid price. So there is a large uninformed buy. So obviously the buy is running up the book and the spreads widen for a short period of time and then they come back. So in the post-trade steady state, your spreads may be wider and the prices are also higher. So the relative spreads could still be as same as before. So in the context of Kyle, the prices have gone up. They have not come back to the pre-level. So in other words, the resiliency of the market is not as good as what it should be. The market has still not figured it out. But in the context of the paper of Foucault and also the current paper, this would be under a state of fully resilient market. So the reason I'm trying to say this is that I think the price resiliency is a very important concept from a trader's perspective because it is basically a measure of the market's ability to detect an uninformed trade. Because the moment the market has figured it out, the prices should bounce back to the normal level. But sometimes the spreads may not, and there could be other reasons along with it, and the time it takes for the spreads to come back, the relative spreads to come back, might actually be different to what the original papers are saying. Okay, so the measure of resiliency that they use is a Ornstein-Uhlenbeck structure, which is largely a mean reverting process. So I avoided the Greek, so I didn't have the problem as you had. So it's basically a current liquidity minus past liquidity, which is the change in liquidity, which is a function of resiliency measure times the long run liquidity minus the previous liquidity. So in other words, if the market is fully resilient, after the trade, it is going back to its long run equilibrium quicker. So if the markets are resilient. So that's the idea behind this thing. And the half-life is largely a measure that comes out of this equation. So now I want to spend a little bit time on the market structure. So I think this is where it could be useful to understand how this data is set up. So first is they use London Stock Exchange, which is a large market there. And around this period, the market share is about 60%. So this is, as Pradeep mentioned, a lot of the ECNs came in at that time, Turquoise, Kayaks, and so on. So all of these marketplaces, when they started, they immediately captured a lot of market share. So in a typical, an example I would like to give from the US system is that if you have a maker-taker model, it's possible that you can have all the limit orders in one market and all the market orders coming into the other market, but they are well connected by this regulatory structure called the Reg NMS. The smart order routing system allows you to move the order from one to the other, and it is a regulatory responsibility. You cannot avoid it. But in the London Stock Exchange, it is a fiduciary responsibility. So which means there is no regulation which is forcing you to route orders to the market with a better price. And so whenever it comes to a fiduciary responsibility, you would know that it is very difficult to prove, right? I mean, it's very hard to prove a broker is not enforcing his fiduciary responsibility. So I think that structure in LSE is different from NYSE or the US markets, because the US market, you can safely assume that it doesn't matter. And why am I saying this? It's because you could have a whole lot of side contracts between the individual market and the traders that could completely determine the order book composition. Which will, for example, you are using a lot of limit order from LSE itself. So it's possible that a lot of the really active limit orders might be sitting in some other markets. And just by looking at LSE's limit orders may not capture the resiliency fully in that marketplace, even though the trader may actually feel it's resilient. So that is one argument.
A couple of minutes, you'll have to close.
A couple of minutes, okay. So then the second one is on the stocks. The large and liquid stocks is what's being used. And the tick sizes could be binding in these stocks, right? So if you think about it, where if you're talking about a really liquid stock, probably the spread is equal to one tick. So in which case, whatever changes in your relative spreads that you're seeing is basically changes in prices. Because the spreads are going to be very close, the absolute spreads would be very close. And some of them could also be cross-listed in the market. So the market structure, which I completely got shut out, I don't even know what I wrote there. But let me get to one other comment, which is the entire Foucault paper is about uninformed. I mean, basically the assumption is that there is no information trading, but you're taking it to the data, so there is a possibility of information contaminating some of your results. So maybe separating that out could help, especially on days or stocks where the trading is less likely. The crisis results could be influenced by regulatory rules, I mean rules that change or impede the provision of orders. There's one other thing on terms of the data that I forgot to mention, which is if you look at the Foucault paper, the idea of resiliency is an order comes in, runs the book, and then immediately somebody comes in to get out. But the data that they have is a 5-minute data snapshots. So which means literally you think about the order book at time t, then it's time t plus 5 minutes. So clearly in an algo world, the 5 minutes is eternity, you know. So clearly whatever snapshot that you're seeing t plus 5 could be driven completely by some other event, not the previous trade that is coming 5 minutes earlier. So I think the question is, having a 5-minute snapshot is going to be a hugely detrimental to measuring the resiliency as you call it. But I think the way to position it is the long-run resiliency of this market, not the trade-by-trade resiliency that Foucault is talking about. So it's basically the idea that is there a long-run spread, average spread that is there, a steady-state long-run average spread that is there in the marketplace for that stock. And if that is what we are going to capture, then I think this 5-minute data will not be a problem. Okay, so a couple of other smaller things, and there's also a new paper which you may want to look at, which is looking at this particular order book resiliency under a high frequency environment. All right, thank you.
So is resiliency also related to the liquidity risk that the asset pricing studies have shown to be priced, like Pastor and Stambau and Acharya and Pedersen type liquidity risk? Is resiliency related to those measures in the cross section?
Yeah, sure. You can respond now. Yeah, sure. That will be better. Then you can take up this question.
Okay, thanks very much, Venki, for your very insightful comments. Particularly, your practitioner perspective is extremely useful and relevant, and I will also talk to you offline, clearly. I think the point which was made about price resiliency versus liquidity resiliency is an important one. What we examine in this paper is resiliency in liquidity, which is relevant for a large number of market participants and relevant also in the context of crashes. So the regulatory concern about crashes, what is a crash? A crash is when a spread becomes extremely high. And so how does the market bounce, how quick does the market bounce back after that? So the resiliency in liquidity is what this paper is examining. We have a separate work in progress which is looking at price resiliency, and we didn't want to mix this up. Yeah. Right. Right. Right, okay. So for example, I was chatting with a gentleman yesterday who is a high frequency trader in this market, both on BSE and NSE. And he said that he was a very active HFT trader, but now he has stopped. He says all the action is really in the derivatives market. And in the derivatives market, all the contracts expire in a month. So everything is oriented towards basically speculative activity. And he is not able to do any kind of high frequency trading because the spreads don't bounce back in the cash market. So, and he doesn't want to be in the derivatives market because derivatives market is purely speculative market. So his entire focus was that he's left this market because of the fact that the spread resiliency, if you like, is much lower or has dropped in the cash market for whatever reason. So I think the issue of price liquidity resiliency is an important one, and price resiliency itself is an important area to study. I perfectly agree with that. The issue about the crisis results and the being distorted by the regulatory ban, we have actually used that to establish causality, which results I didn't present, so I think that's an important one. And I fully take the point that what we are looking at is more like a long-run resiliency, and therefore the Foucault et al. Model is more a guide rather than a direct application. So coming back to Prachi's point, which is in relation to, I'm kind of trying to remember, yes, volatility.
Can I,
yes.
Do you want me to repeat? Yeah.
No, I think I remember. So the tests for pricing that we do, we include all the volatility variables, et cetera, all the conventional variables. And we find that they get crowded out. It is resiliency which seems to remain. And though that's coincidentally identical to another paper I have on bond market, we're looking at 3 liquidity dimensions, and we find that that's the case there as well. So, and Venki, thanks very much.
Yeah. Okay, can we move on to the next paper? You have a question? Yeah.
Partly question, partly comment. Thanks. I found your presentation very useful in the sense that I now understand things which I sort of vaguely thought I understood. I was looking at it, like Venki said, from a practitioner's point of view. And when you were talking, there was this discussion that we had a few months back on an episode in the market. And this is, there is this company, Maruti, which had a union problem at their plant, and because of which there was this huge shock, the price shock. People started selling, and then over a period of 2 or 3 days, when some of the buy-side investors decided that this is a good opportunity to buy, the prices started coming back. We have periodic such episodes, and this thing happened because we were discussing this particular episode happened, I think, on a Wednesday or Thursday, and then there was a time, Thursday, Friday, when people didn't know what was happening, and then phone calls were being made, people were discussing this, and by Monday, Tuesday, things came back to normal. The price dropped, but I guess these spreads and depth, etc., were restored. So your study was at a market level, right? But I think it will be very useful to look at such episodes on a stock level when I don't know how relevant it is to the particular work that you have done, but to see how the market is reacting to this kind of information as people digest information, take decisions, and bring the quality of the market back. And as a practitioner, I'm interested in this because I know that shocks are going to come. And as you said, there is a market, the cost of my trading, my long-term cost of trading is determined by how the market structure, how the market would react to these shocks. So I'm just wondering whether you have any thoughts on work that can be done or utility of ideas like this.
Yeah, sure.
So 2 or 3 points here. Number one, the study that we have done is completed at a stock by stock level. So I'm presenting the results as averages, but we're not looking at the market as a whole. That's averaging the stock by stock results. So it's completely stock by stock. Second, this particular study, of course, looks at the hunky-dory time, where everything is going well. We're not looking at extreme periods, really. The paper, which I'm going to present later, is one which is focused on extreme periods. This is more in the style of the existing literature on high-frequency trading, which shows that on average, high-frequency trading is good. Now, this is again showing that on average, this is how resiliency behaves most of the time. So yes, we can certainly look at extreme periods in addition to that. And your point about the bouncing back in extreme periods, it's very valuable, and some of that I'm going to cover in the next paper that I'm going to present.